I'm Charlotte McLeod with investingnews.com, and here today with me is Don Durrett of goldstockdata.com. Thank you so much for joining me. Great to have you here once again.
Yeah, Charlotte, it's great to be back on the show. I had a question. Your last name is McLeod, so there's lots of McLeods in the mining business. Are you related to any of them?
That is a question. It's a great question, and it's a question I get a lot. And unfortunately, no, I'm not related to any of the other mining McLeods. I'm just here a standalone.
Okay, but thought I would ask.
I think probably many people wondering the same thing. So thank you for asking. I don't usually get a question in these interviews. That's great. Okay, so let's get into my questions for you. We're speaking here on the afternoon of August 6th. And after a pretty rough day in the markets yesterday, it looks like we might be seeing some improvements. So I'm really curious to get your take on what happened there, and maybe more importantly, whether we're through this or if this is just the beginning of something.
Yeah, I think a lot of people are interested in that answer. So I've been waiting for the recession to begin. I'm not a believer in the soft landing. I've always believed that the economy we've been in a 15-year growth cycle since 2009. I just feel that it's coming to an end. And I think some people recognize that it's coming to an end and they're nervous. And other people are, kind of in this attitude that, the Fed is the masters of the universe and they can keep this thing going. They just keep kicking the can down the road, and I'm going to stay in the stock market until it finally collapses, and maybe it never will kind of attitude. I'm more in the pessimistic camp. I've been waiting kind of thing. So this year, it's been really calm as far as the stock market goes. We haven't had a down 2% day this year until July. And in July, the NASDAQ was down 3.6%. And I thought that was probably the bell ringing. And then we have to wait for, kind of the follow through. And I think yesterday was kind of the second, bell ringing, or the second data point that said, here we go kind of thing. And then last Friday over the weekend, there was news that Warren Buffett had sold half of his Apple, which Apple has been his number one holding. And that was kind of another bell ringing event. And then we had unemployment jump from 4.1 to 4.3. That was another big data point. So the low on the unemployment was 3.4. So we went from 3.4 down to 4.3. That's a big move, trending in the wrong direction. And in the last 12 months, unemployment has not been strong. Wall Street has been focusing on the number of jobs gained, and it's been when it's over 200,000, they're like happy. They think everything's fine. But full-time jobs have actually been negative. So even though we've been seeing these decent numbers, the full-time jobs haven't been good. They've been really weak. And then we had the bad jobs number last week, 114,000, which is probably negative because the birth-death model probably is the whole 114, plus probably government jobs and healthcare, which healthcare is subsidized by government. But the overall economy has been getting weaker, and the underlying strength of the economy has actually been weakening since 2000. This has really been a 24-year bear market. The only reason why we've had growth is because of injections of money. We've been living off of debt and liquidity, and not really real growth, if you will, in the economy. And now the inflation took off in 2021, 2022. So now the cost of living problem that's a new problem. It didn't exist prior to 21, this cost of living problem. On top of, the Fed was already trying to generate GDP growth through liquidity, through money printing. And they didn't have this problem with the consumer. And now the consumer, in many cases, is insolvent. So we have this juggling effect where families are basically juggling their balance sheet each month. Rob Peter to pay Paul kind of thing. They're constantly, or what can we cut, if you will? What do we cut out of our budget? And this isn't a small problem. This is a really serious problem because the U.S. economy is 70% consumer spending. And so now the consumer, big chunk of it is having problems. Yeah, the top 25% are okay. They either have plenty of savings or they have enough income where, they can add credit or whatever. So that's the reason why the airports are full. The airports are full and the stores are full because basically 25% of the population are still doing fine. It's that lower 75 that are having trouble, and especially the lower 50. But this didn't exist prior till like 2020, and then 2020 was, of course, COVID. But the economy and the consumer has been, hitting the stomach here a little bit. So I think that this 12% drop on Japan Sunday night was basically the second indicator that things are going south, if you will. Now, we bounced back today and everybody thinks everything's fine, but I don't think so. I think we're going to get some more rattling, if you will. Especially we're going into seasonality. So this is not the time of year you really want to see weakness in the stock market. This is not the time of year you want to see volatility. And so I think August, September, and then you go into October. And so we're really looking at, last year was the same thing. And I expected a big correction. We got one, but then it bounced back in October. Now, this time, I think we're going to get something similar. So it's kind of like the gauntlet the Wall Street has to get through. It's basically 90 days, from the next 3 months. Wall Street has to get through this period again, like they did last year, and land on their feet. And they are going to get a cut in September. I think it's going to be 50 basis points. They're going to get a cut. So they're going to think that's going to solve the problem. But I think that we're going to see kind of like a 2008 scenario where you start seeing events, big events. So we haven't had a bankruptcy yet. Lately we had a couple of banks go bad, but we haven't had a really big bankruptcy, kind of a Lehman, Bear Stearns event. And I think those are coming. And I think Q4 is going to be very, very negative for the markets and better for gold and silver. We'll go to there.
Definitely. I think before we head over to gold and silver, I've got one more question on the Fed. So we just had the latest Fed meeting last week. Rates left unchanged, as was widely expected. Now everybody's looking forward to September. And you were looking for, is that in September, a 50 basis point cut? And then what do you think the Fed does after that as things start to unravel further as you see coming?
So I've been saying that the Fed is feckless. They basically have lost control, and nobody's acknowledging that fact. And so in 2008, when we had the last recession, the Fed could do whatever they wanted to do. They could be proactive. They could lower rates to zero. They could lower rates as fast as they wanted to, and then they could print as much money as they wanted to, and it wasn't going to cause inflation. So they were in a perfect position to basically not only in the recession, which they did, in June of 2009, the recession was over, but they were also in a position which they pivoted. In 2008, the Fed pivoted in many respects. They were working hand in hand with the Treasury to do any bailouts that were necessary. And they basically took the Japanese playbook because Japan in the 1990s, their central bank became very active. They were buying bonds, they were buying ETFs on the stock market. They were very active. And in 2008, the Fed basically said, we're going to use that same playbook and basically manage the economy. And they were able to do that from 2009 until today. But look at the debt expansion from 2008 to today. It's been unbelievable. It's been growing at, I want to throw a number out, but if it's not double digits, it's close to double digits. annually since 2008. Probably not double digits, but 8%. It is double digits today. So debt is growing has been growing at an unbelievable pace, especially since 2020 versus GDP. And you can't do that. You're basically using money to print GDP. And that's what we've done with our budget deficit. So you have a $2 trillion deficit. That is actually borrowed money to stimulate the economy. They'll probably not say that's what they're doing, but that's the effect it's having. And so we're stimulating the economy. It's not really a true GDP level. So a GDP would be negative. Let's say if we had a $500 billion deficit, we'd have negative GDP right now. So and we've been doing this since 2009, and there's not been any talk in Washington that we need to cut. There's none. Let's just keep rating. In other words, the only discussions we have is to increase the debt limit. That's the only talks we talk. That's the only thing we talk about. We never talk about cuts. There hasn't been any serious cuts in this country since the 1990s. I don't. And where people have had to actually accept pain, if you will. Washington, that went away when 9/11 happened in 2001. There's been no more talk of, okay, we're going to do some serious cutting. So we've been living off this mandate of MMT, which is the Fed has adopted. And so the Fed's balance sheet, prior to 2008, was less than $1 trillion. And today it's about 8, I think. And so that's all been money printing. That's all been expansion. So they've been, it's basically been injection after injection. And I don't think that when I said the Fed was feckless, now they're reactive, and they're going to have to be reactive. So it's going to appear that they're proactive because they're going to lower rates. So I think they're going to cut 50 basis points in September. Now, if the stock market gets back on its feet, if we go all the way back to, let's say, if it's the next meeting, if the stock market is above 5,500, because I really think that the stock market is a really big indicator for them. If the stock market is above 5,500, then there's a possibility they'll do 25 basis points. But I don't think we're going to be there. That's the reason why I think it's going to be 50, because I think stock market is going to go lower. So it's going to appear that the Fed is still in control because the Fed is cutting rates, and we can cut rates. However, they can't cut rates to zero. So they're reactive. They're like, okay, how low can we go? And then how fast can we go? So they are reactive to the market because they can only cut so much and so fast without spooking everybody. So that's kind of reactive. And then the other place where they're reactive is they can only print so much money. And so and they know it. And so if they print too much, it creates inflation. And then you get a doom loop, because if they print too much, it weakens the dollar, and then the bonds get weaker, and then people sell their bonds. And the dollar's in big trouble here. Yesterday was a big indicator of that. The dollar went down yesterday. Usually the dollar goes up a little bit when you have a big sell-off, or it goes up a little bit when you have a big crisis. Well, I would think a 12% sell-off in Japan was a crisis, but the dollar went down yesterday. That's a really ugly signal for the dollar. The dollar's in trouble. So if they cut rates, which they will do, rates will go down. And the rates have dropped from 4.2% to 3.8% in 2 weeks. And I think the rates are going to go down to about 3.3 somewhere around there as they cut. But that's going to look good initially, because if you own bonds and rates go down from 3.8 to 3.3, then if you're owning the TLT, you're making money. And so people are initially will run into the TLT and make money. As the rates go down to 3.3, they'll do pretty good. But then we'll hit a floor, and then the dollar goes down, and rates will initially go down. But then people are going to start jumping off the boat as that dollar gets weaker and weaker. And then you start getting, and then they start dumping their bonds, because then rates start going back up as they print money and you get more inflation. So I think that, I don't think that people that buy bonds here, I don't think that they're going to have this fantastic bull market where it just goes down, 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 like, kind of what we've been used to for the last 35 years. I don't think that's going to be the case. I think we're going to go down, and then we're going to hit a floor, and then bonds are going to start going back up again. And that's when the problem starts for the Fed, because then, how much money can they print? And then as people sell their bonds, the Fed's going to have to buy them. And if the Fed has to buy more than 50% of an auction, let's say an auction's 200 billion and they have to buy 100 billion, or have to buy 120 because there's no buyers there, that's kind of a doom loop, because people are going, wait a minute, because that's all injected. When the Fed buys bonds, they have to print money to do it. So if they're buying half of an auction, all that cash is going into the economy. And if inflation's at 3.5% and they're buying bonds, then bonds are going to get weaker and weaker. People are going to sell their bonds. And that's that doom loop. That's why I say the Fed, they are no longer masters of the universe, even though they're perceived that way. And then once people realize that the Fed can't save us, that's when the trouble really begins. The Fed has to project that they can fix things, and everybody has to have confidence in the Fed. And if they lose the confidence in the Fed, then that's when gold and silver are really going to shine. That's my thesis, really. My thesis is that the debt bubble is going to pop, and by pop, I mean that the Treasury and the Fed cannot print at will. Once they basically realize that, the U.S. Treasury will go to Congress and say, you guys have to cut. That's number one, and that's going to happen. And then another one is when the Fed realizes that they can't expand M2 anymore. If they expand M2, then inflation's going to take off, and everybody's going to have their eyeballs on M2. So they can't hide M2, and M2's down right now, and they are going to increase it, but they're going to hope and pray that that it won't come back and bite them. As M2 starts going up, that inflation doesn't go up. But I don't think they're going to be lucky. I don't think they're going to be able to keep inflation from, say, 3.5. And any inflation at 3.5 or higher is bad for the economy. I think maybe 3.2, 3.0 we can kind of live with, somewhere in there. We know we can live with 2.5, but we're not going to get to 2.5. So I think 3.5 is problematic. Anything above 3.5 is problematic because the cost of living problems. If you're at 3.5 inflation, nothing's coming down, right? Nothing's coming down, and everything is inching up. It's a 3.5 inflation is a problem. That's why 2% is the target. 2% is the target because 3.5 is a problem, and I think that we're not going to be able to get below 3.5, and we're probably going to have another. I think next year, I think oil prices are going to take off, and when they take off, inflation's probably going to go to 4 or 5. So the inflation genie didn't go away. We're going to get a second round of inflation, and when it comes, I think the recession will already be here. The problems will already be here. The inflation will just kind of add fuel to the fire, if you will. As far as the economy trying to get back on its feet, inflation will say, no, you're not, sorry, you're not going anywhere.
Okay, I think you paint a very clear picture of where you see this all going. And I'll let us go over to gold and silver now. So of course, we know that these are safe haven metals, especially gold. But during these volatile market events, they do tend to, at first at least, go down. So we did see gold below 2,400 this last day or so. Silver, I believe, below 27, although you can tell me if I'm wrong on that one. So they've both gone down. Where do you see the floors for gold and silver?
But before I tell you the floors, because I have ranges, I want to talk a little bit about the price action yesterday. No, I don't think it traded below 27. I think The wick might have been below 27, maybe, but I didn't see it. I saw low 27s.
That'd
And
be my
then,
mistake.
yeah, and then, yeah, I'm showing today 27.13. So maybe we did trade in the 26s. So for me, this is all about gold. And I'll explain why. So gold yesterday, I was actually surprised that gold held 2,400. So the two surprises to me yesterday was gold holding 2,400 and the dollar going lower. Those were my two surprises. I thought we would go below 2,400. Now the miners did get brutalized yesterday, even though gold held. So I've been saying that the odds are that when the selling begins on Wall Street, that gold, silver, and the miners would all go down, but it wouldn't be a deep correction. And this is where kind of the bottoms come in. I see it as kind of a 10% correction in gold, which would be around 2,200. So my target is 2,200 to 2,300. And you can say 2,250 is kind of the bullseye. So I'm expecting about 2,250. So I expect it to go lower here. Now, if we go below 2,200 on gold, I don't think it'll last. I only see, if we go below 2,200, maybe only stay there a couple of weeks. That's about as much as I see it. And then on the upside, I don't see us breaking out unless the stock market gets a new high. If the stock market can get a new high, then I think gold will melt up with it. But I don't see us going above 2,500 until you either get the melt up above or you get the breakdown in the S&P. So I think we're in this range, 2,500 to 2,200, waiting, and I'll talk about the silver low next, waiting for the S&P to basically break down. So as long as we're above 5,200 on the S&P, I think everybody's happy as far as investors goes. Nobody's jumping off the boat. Nobody's really selling. And they're waiting for basically, this is just a minor correction. Normal correction is what they're calling it. And then we'll just go higher. And so everything's fine at 5,200. And that's kind of the sweet spot. So gold's going to stay in this range. If the stock market stays in the range 5,200 to say 5,600, gold will stay in this range 2,200 to 2,500, probably 24 somewhere. But they're both going to basically be range bound until the stock market shows us where it's going. Gold's following the stock market here, but it's not going to break down. Whereas the gold is okay. So then 5,200 that's kind of safety. Everybody's fine with it. But once you go below 5,200 to 5,000 is the nervous zone. That's when most people hang around. They're nervous, but they're hanging around, but they got their eyeballs on 5,000. So it's kind of that's the nervous Nellies as 5,000 to 5,200 or some early exiters. But once you go below 5,000, then you get into the danger zone, which is 5,000 to 4,800. And the danger zone, that's where people decide. A lot of people decide, do I stay, do I go? And you'll see a lot of people jump off from 5,000 to 4,800. And that's the danger zone. That's where everybody's eyeballs now are the next level, which is 4,800. And that's where Wall Street's got their eyes glued to 4,800, basically saying, that's where your stops are. They're like, so below 4,800, that's when the rafts jump off the boat. That's when everybody's heading for the life rafts below 4,800. You're just taking too much risk below that because once you get below 4,800, you start seeing some levels that are just kind of things, like 4,300, 4,200. Just those are where you go to die kind of thing. You just don't want to see that in the next 30 days, for instance. It'll too far to be a bloodbath if you get below that. Now, so that's where we're at right now. We're kind of in this trading zone in the stock market, 5,200 to 5,600, and then gold's going to follow it. So we're just kind of in the wait and see mode, watching the stock market. Watching the fundamentals of the stock market, the macro, and looking for black swans like we had in Japan, and kind of like what we're happening in the Middle East right now with Hezbollah and Iran and Israel, all, basically that could expand, and that could get like right now the price of oil is at 73. Oil could, that's helping the economy a little bit. So oil could spike back to 80 in a heartbeat with a couple of bombs from Iran. Now let's go to silver. So my thought on silver is it's kind of irrelevant as far as in importance, because gold is so much more important. Because gold gets above 2,500 and silver is just going to rip to 35. You're just not going to stop it. It's going to squeeze like a sponge on the GSR, the gold silver ratio. Like right now it's in the 80s and it'll go down into the 60s. It'll just rip. And so silver is just hanging around, waiting. It's in waiting mode like everything else, waiting for gold to signal. I call gold big brother and silver little sis. And so gold is the masculine sign. Gold is ruled by the sun. It's the Leo. It's the masculine. And silver is, I call her little sis. She's the feminine. Silver is ruled by the moon. And you can't understand silver, and you can see why. It shows the feminine side, right? Silver, you can't understand her. She's very, very volatile and drives everybody nuts. But silver, the one thing is, this is really interesting. It's fascinating. Silver wants safety, and women like safety. And so silver will wait until the coast is clear. She waits until she feels safe. And when silver feels safe, she comes running. And that's what $35 gold will do. You go, oh, the coast is clear. Here we go. Silver, and so when silver runs, it's a sight to behold. I mean, you talk about gold fever. Gold runs well. Silver runs like 3x as fast as gold, and so she can go up $5 in a week. I mean, it's just really intense volatility. And when she runs, I mean, for silver to go from like right now 27 to 35, could do it in a month easy. It won't take much. When she decides she's going to run, she lickety split. Here she goes. And so again, I don't worry about silver as being important. So 26 was my bottom. If we go below 26, so this has been in my range. So we kind of went down there and hit 27. So I was kind of right that was probably where we're going. But I don't think we're going to 25 or even get a 25 handle. But if we do, it won't stay there very long, and it'll bounce out. Kind of like gold below 2,200. I don't think it'll go there. The only way that we go below these bottom targets of mine is if the economy basically gets stronger. So they lower rates in September, and GDP just, goes back to 3.5, and then the autos and cars start picking up because they lowered rate 0.5%. And then retail picks up a little bit because credit cards went down 0.5% or 1%. That's the scenario where, it's possible that we could go lower. But more likely, if the economy gets back on its feet like that, gold and silver will melt up. They'll go with it. They'll go higher with the stock market. So if things get better economically, gold, because I don't think the risk has went away. I don't think the uncertainty is going to go away. Even if the economy if the economy stays on its feet, I think uncertainty is staying with us for a while. So I don't see gold and silver breaking down. So actually, I'll throw another scenario out there, and that is if for gold and silver to break down, say, for gold to go, say, between 2,000 and 2,100, and silver to go to, say, 24 to 25, the only way that would happen is if the stock market crashed. So if the stock market crashed, brutally, right? So that means we go down to 4,500, and then we go down to 4,200, like in 2 weeks. If we crash down to like 4,300, maybe even 4,400, like a 2 week period, that could push gold down. That would probably be the scenario, but I don't expect that. So I don't expect either of those scenarios. So I'm pretty confident that those ranges are going to hold.
Okay, thank you for going over that. And I think it's really clear what you're watching in terms of drivers when it comes to gold. There's a lot of other, I guess, factors out there that I hear discussed when it comes to gold, like you mentioned briefly, geopolitics. It's an election year in the US. We've got the central bank buying. Are those things becoming more like noise, in your opinion?
No, the geopolitics is having a huge impact on gold for a number of reasons. In the near term, you have the Middle East. That's definitely having an impact on gold. But then you have this dollar weakness, or not the yen weakness, if you will, and then which push down the dollar. Any dollar weakness can actually push gold higher. A weaker dollar is going to push gold higher. And that internationally, you have a lot of international demand, and they own a lot of our bonds and they own a lot of our dollars. So any weakness in the dollar people are going to move that to gold. And it's a big market. And so I think the dollar's in trouble here, and geopolitically, that helps gold immensely. And then you have the BRICS and the Ukraine war. And I just think that is underpinning gold. It's been helping gold immensely. I think the BRICS are going to create some type of a trading currency. And I think it will be likely a crypto on a blockchain, and it likely will have some type of gold backing. I think they're going to announce that in October. I think it's huge for gold. Absolutely huge. We should start hearing rumors. We're getting closer to October. We've had a little bit of rumors, but nothing I don't think that's significant that actually implies that it's going to happen. But I think as we get closer, they're going to start talking about it's going to be on the agenda. It's going to happen. The one country that doesn't want it is India. And the reason why is because they're the ones that are going to have to buy this currency, because international trade will be done in this, some people they're saying they're going to use the unit, which is a possibility. And the unit is just a crypto name. It's just a token. But if India has to buy units, they're going to have to buy them with the rupee. And when they buy them with the rupee, it's the same problem that other countries have to do with buying the dollar. And so they don't want to have, because they're not an exporting country, they're more importing, especially energy. So if they're importing oil and natural gas, they're going to have to be giving the units to Russia. So Russia doesn't have to buy any units. They get units, but India has to buy them. And so India doesn't want this. But so that's the fly in the ointment, is how do they get India on board? Now, if they're smart and they realize this is the weakness, they will subsidize India to get them on board. They'll basically say, look, we will buy units for you. We'll subsidize you. And everybody will do that. So the big exporters, China and Russia, maybe some other countries, will basically say, look, we'll help you. We realize that your currency is going to get hurt. But guess what? We will prop up your currency. We'll help you out. We'll give you, $10 billion of units. We'll give you some free units. But that would be interesting if that is the outcome, because I see India is the problem here. And if they can get India on board by making a deal and say, look, yeah, we realize that you're the loser here. So you're the loser. We'll help you. That's, what do we need to do to rectify this, to make it work? And so there's that. So also in geopolitics, you have these countries that are moving away from dollars. And that is positive gold, because when they move away from dollars, they're probably going to convert the dollars to gold. They sell their reserve currencies like, I don't need these anymore. I don't need as many of them. Then I'll sell my dollars and buy gold. And that's that. So the geopolitically, I think, is unbelievably helpful for gold here. That's why I think we're going to be somewhere between 2,600 and 2,700 in gold by the end of the year. A lot of it is geopolitical. As the U.S. economy, because I think we are going to recession here, as the U.S. economy goes into a recession, you're going to have a lot of foreign money pull out of the U.S. Like 40% of our stock market is foreign money. 40. I mean, it's a huge number. Our bonds isn't quite that. It used to be 40% of the buyers. Now it's more like 30% of the buyers, because Japan and China aren't buying as many of our bonds, but still, a big chunk of our bonds are foreign. So if they turn into sellers instead of buyers, when they're a seller, they're selling dollars. And when they're a seller, stocks are a seller of dollars. More downward pressure on the dollar, which is great for gold. So gold benefits in two ways. One, it benefits because the dollar's going down. Two, it benefits because when they sell those stocks and they get dollars back, it's very easy for them to convert those dollars, whether they sell the dollars, they could just take the dollars and buy gold once they have the dollars in their hand, and if they sell stocks, they're going to buy gold. So, and final thought, gold is a safe haven. So if the U.S. economy, which is 25% of GDP, looks like it's going into a recession, they're like, I want to go hide somewhere. Well, gold is one of the best places to hide, especially when gold is trending. So it's like if gold is trending and people are expecting gold, like I said, 26 to 2,700 by year end, it's going to be trending, right? That's going to think about it. If gold's at 2650 in December, and you look it up and you see the price of gold, you're going to go, I wish I had some gold, right? It's going to be an eye-catching number. It's like, damn, I wish I had like 10 ounces of gold, right? And so so geopolitically, I think it might be gold's strongest advocacy of owning gold right now is geopolitical reasons.
Okay, really good to get into that as well. And of course, we have to talk about where do gold and silver stocks go during this scenario. So we're looking at $2,600, $2,700 gold by the end of the year, silver following. I know that many people are looking at the equities and thinking they should be performing better. When do you think that starts to happen?
So if gold goes down 10%, you basically get $240. And I was doing it off of 2450. So off of 2450, you basically go to 2200. So it's 10% drop. So if you get a 10% drop in gold, you're going to get a 10 to 20% drop in miners, depending on the quality and depending on sentiment. But if you only get a 10% drop, you can look at kind of the price action yesterday. Newmont, for instance, held up better. It was trading at 29 in February. Its high was a couple of weeks ago was at 50. It was trading at 47 yesterday, which is only about 10%, less than 10% off, 3% off the high. So it's hanging in there. So the quality names are like, they're not breaking down here. I mean, from going from 29 to 47 from February to now, that's a good move. It's basically showing that it's going higher with gold when it's not breaking down. And so the quality producers, any company that's like $500 million a producer, any producer that has a market cap of 500 million or higher is probably not going to go down 20%. I don't think, unless it has high cost. There's a few that might, but the vast majority of them I don't think are going to go down 20%, and they probably are only going to go down 10. So HUI actually went up today, which is kind of surprising because gold was actually down today. The HUI is 288. When I looked, yesterday it was 283, so it was up 5 points today, with gold down today and silver down today. So that shows me that people are starting to recognize that the bottom is kind of, and I've been saying this, the bottom is in for the miners. I mean, when we're talking about bottoms, I'm talking about, what we were at in February. We're not going back to February. So now it's just a matter of we are going to have a higher low, and that's a great sign for miners. I think for me, the bottom is 250 on the HUI, so we're at 288 now. My bullseye is 263. And so and after the price action today, I mean, maybe we won't even go to 263. So as long as 250 holds, I have no problem holding here. I mean, I'm not a trader anyway. I'm a buy and hold guy, but I don't need to put money on the side and start accumulating cash and waiting for a dip, because 250 is what I call neutral on the HUI. That's not even my buy zone. My buy zone is 225, so we're not even close to my buy zone. 225 to 250 is opportunities. You're basically below 225. You're trying to buy. You're trying to spend all your money, and then below 200 is load the truck, and then 225 to 250 there's lots of opportunities. You can find lots of cheap stocks from 225 to 250, and then from 250 to 275, it is kind of the same thing. There's still lots of opportunities there. Maybe you can actually go all the way up to 300, 250 to 300. And so, but 250 is the neutral, kind of my neutral zone. And then from 300 to 400, that's when the train's leaving the station. And we're not there yet. So below 300, this train's still sitting in the station. There's still tons of opportunities. I actually bought two quality producers yesterday. They're not even pricey yet. I bought Bellevue and Capricorn, Bellevue Gold and Capricorn Metals. I didn't own them. It's like, okay, what stocks am I going to buy here? But the train is still in the station, so I was like, this is my last chance. And so we're not in last chance zone. We're still 250 to 300 is there's still opportunities. Like I said, these stocks they're not even that pricey. Now, they're not five baggers, but I want to own as many quality mid-tiers as I can. And these were two I didn't own. I've always had my eyeball on. Bellevue recently had a big correction. I had Capricorn. I've been waiting in Capricorn I've had it on my watch list for over a year now, and I haven't bought it. It was kind of the last one I was going to buy. That was one I was waiting for a correction. So we had a correction yesterday, and I'm like, okay, and Bellevue got sold off, and I said, okay, this is my chance to buy Bellevue because I never had. So the only one I don't own now that I kind of would like to own is Gold Road in Australia, mid-tier. I think the only mid-tier I don't own that I kind of, but it's too pricey. I don't think I'm ever going to, I think that's the one that's going to slip away from me. But there's still opportunities. But now we get above 300. So 300 and the 325, the train is leaving. But it's going slow. And then, once you get above 325, the bull market begins in miners. That's when the train's going. So it leaves the station at 300, but it's going slow. 325, it starts to pick up speed. And then from 350 to 400, that's last chance. So I think we're going to see last chance in Q4, because once the who is above 400, I won't buy any miners. I won't buy any. I probably won't buy any above 350. And so I won't buy any. And then I turn into sell to the top mode, exit mode. So that's how I see it.
Okay, I think that gives a lot of good ideas for investors, timelines to think about there. As we're starting to wrap up, are there any final points that you would leave people with heading into, I guess, the last half of the year here? Anything else on your mind you think people should know?
I really feel that America is on a transition point, a paradigm shift, a new era shift, and that in Q4 it's all going to become apparent. I think it started in 2016. 2016, you had Bernie Sanders, actually 2015 leading to, and then 2016. That maybe 2016 is when it really started. But Bernie Sanders, he changed the Democratic Party dramatically. I mean, before Bernie Sanders, as far as I'm concerned, Obama was a moderate. I mean, other than Obamacare, what did Obama really do that was, far left? Nothing really. Bernie Sanders was the guy that really brought in all of these, basically gun control, equity, high taxes, extreme high taxes, all basically a lot of extreme stuff that really, really scares the hell out of the average American. Let's put it that way, right? So the Democratic Party moved left, severely left. Bernie Sanders was the trigger, and then Biden kind of followed through on that. I mean, he said his high priority was equity. Well, equity is kind of a term for, flatten, basically, do away with the old American model, which is, to the winner goes the spoils kind of thing. Now it's no, we can't do it. That's not working. We gotta create equity. Well, kind of, it's a big shift in America, right? And so that started in 2016, and then Trump got into office, and then Trump, he shifted everything. And then in 2020 we got COVID, which was unbelievable, jolt to the American political system, and the American social system. And things have just gotten really wonky since 2016. And the one thing that hasn't changed, that's held up, is the economy. And I really feel that Q4 is when it's basically the third, strike, or the third domino, or the third data point. So you had 2016, politics and media, the mainstream media. And then 2020, you had our institutions basically break down. And in 2024, I think the economy breaks down. And I think that it's going to be, buckle up kind of a situation here, because I think that 2025 going forward we're going to be entering a new era, and it's going to be dramatic. It's not going to be easy. I think the next 3 years, 2025, 26, and 27, these next 3 years are going to be unbelievably hectic and just unbelievable change. I call it, and there's a guy named Cliff High called it hyper novelty. Hyper novelty is when you get an event that's unexpected. And what? That shouldn't have happened, kind of thing. That shouldn't have happened. And then you get those over and over and over again. And I think that's what's going to start in 2025. Just total unexpected. Like what's happening in Britain is a good example. This weekend, if you've seen any of the videos, what's happening in Britain, they're having riots like crazy over there right now. So it's kind of the craziness is going to begin. And then the Fed, so basically the economy falling, and then our social structures, this election, I just think is massive. So our social structures starting to break down, then our economy starting to break down, and then change just, I call 2024 the year that it's the end of Easy Street. So the America that we kind of know and love, what we were always expected, the country that the rest of the world was envious of, now everybody is going to be starting to pity us. They're like, what is happening in America? Are they going to fix their problems? That kind of thing. Instead, it's going to be almost the polar opposite of the way it's been in the past, where it's kind of America to the rescue kind of thing. Now it's going to be, can we help you guys? You guys need some help? Yeah, it's kind of that way. And you're in Canada, aren't you?
Yeah, that's right.
You're going to experience the same thing, but not to the same extent. It'll be on a lesser level, if you will. You guys are actually going to be able to fix your problems whereas we won't. You'll be able to fix your problems because, you don't have the reserve currency, and you're in many respects, your problems are being driven right now by politics, not so much social breakdown. It's more political problems. So your political system can get back on its feet enough to prevent kind of the shakeout that America has to go through. Like America is over in many respects, whereas Canada I think Canada can stay on its feet, or kind of, it won't be as dire as America. America's literally going to have to go in a new direction, which is very, very, scary kind of thought. It's going to have a good outcome, but not until the end of the decade, 28, 29, 30. The next 3 years is, oh my God, it's just, we have to figure out which direction we want to go in. So the next 3 years is all about figuring out where we're going. But we can't fix our problems. Our political system's broken, and we all know it. And so now that we know that we can't fix our problems, now what? And so once the Fed, that's the last shoe to drop. Once the Fed becomes exposed as being feckless, then that's like, we're like a house of cards, and the Fed is the last leg to go, because it's become obvious that our political system is irreparable. So now what do we do, kind of thing. So that's what the next 3 years is about. It's about figuring out where do we go from here. It's going to be quite dramatic, and this is the reason why gold and silver makes sense. Because if our economic system has a crisis, they always say if America catches a cold, the rest of the world gets pneumonia, kind of thing. So yeah, and that's kind of what's going to happen here, and it's going to impact the rest of the world. And so gold's going to, I don't know how high gold's going to go, but I think $3,500 gold is a conservative target. That's my target, 3,500, and I think it's conservative. I think we're going to hit 2,400 within 24 months. We might even hit it next year, which isn't crazy talk. It's not outside the realm of expectation, especially if we end the year above 2,600.
All right. I think it's a sobering place to wrap it up, but you've given us, I think, so much good information to help people navigate through these changes that are coming. So thank you very much for coming on, and be sure to have you back soon to see what's happening.
Yeah. How about November?
Let's go for November. That sounds great.
Yeah. After the election, I think that'd be fantastic. And we can review and see exactly if I'm right. And it won't be that long from now. So we'll both know what I said. And I know what I said because I say it every week. And we'll see exactly where we're at. And then we can talk about what I'm saying about, changes in 2025, if that makes any sense. We'll see, the state of the Fed, how in control of the economy is the Fed? Are people starting to realize that, the Fed can't fix this thing? And the key is going to be, are we in a recession in November? Are we on the verge of a recession? Where's the stock market at? Where's gold at? But yeah, I think, mid to late October, mid to late November would be great.
I'll put it on my calendar. Definitely. Let's make that happen.
Fantastic.
Okay. All right. And for now, thank you so much for coming. Once again, I'm Charlotte McLeod with investingnews.com, and this is Don Durrett of goldstockdata.com. Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.